Olá, turma! Estamos começando aqui mais um episódio do nosso podcast, o nosso Mind Asset. E hoje com dois convidados super especiais para falarmos sobre um tema extremamente relevante quando a gente pensa em investimento, que são as estratégias beta. Eu sou o Renato Eide, Head de Estratégias Beta e Integração ESG na Itaú Asset. E agora eu peço licença para mudar para o inglês, porque hoje temos dois convidados internacionais. Today with us, Tim Edwards, MD and Global Head of Index Investment Strategy at S&P Indices, Benjamin Mendel, who is our Head of Portfolio Strategy at Itaú Asset. As you might know, beta strategies can be expressed via mutual funds or ETFs. They've been showing tremendous growth over the last decades, basically because of the transparency, agility, low cost, and diversification. Some factors that justify all that growth, and SIN has been a very interest to explore. That's why we are here with both to bring some interest concepts to you. So Tim, it's a pleasure to have you here. Could you please introduce yourself and explore a bit more what are index investment strategies and why are they so important in the process of portfolio building?
First of all, thank you very much for having me. It's a great pleasure to be here and to be discussing with you. So you ask a very broad question. Why index? And I'll start with the very broad answer. The role of investment is to access certain patterns of returns from fixed income markets, from the equity markets. And over 100 years ago, a gentleman began to aggregate the performance of stocks across the market and built something called the Dow, the first index in the world. And what did it do? It was a shorthand for how did the market do today. If the Dow is up or the Dow is down, it gives you a sense for overall how is the market doing. That was over 100 years ago. Over the last 100 years, what's happened is that more and more investors have realized that accessing the returns from the whole market, the whole opportunity set, can actually be much more effective than trying to pick the one or two stocks that might outperform. And the role of indices in the marketplace today is very broad. People use them for information. How is the market doing? They use them for trading, get in or get out quite easily. But most importantly, broad-based indices like the Dow and like its modern equivalents give a wide range of investors access to the whole marketplace in a single, transparent and efficient way.
That's great. It makes it easier to understand why those type of investments are getting bigger. So if I can wrap up the broad question, I would say that it's all about provide efficient access to investment themes, and that's it. So let's turn into our another guest. Ben, it's also a pleasure to have you here. You have been working with this concept of portfolio construction for a long time. And for the last 2 years, you just joined Itaú Asset at Brazil. It's been a pleasure. So can you also introduce yourself, please, and explain a little bit what is the main challenge to consider as investment horizon, and why is this so important when you define a portfolio?
Well, thank you very much for having me. Just by way of background, I'm an economist by training, so sometimes I feel the need to apologize for that. I understand Tim has a math background, and so it's good he's here to keep me honest. But as you mentioned, I've been here at Itaú for about a year now. I relocated to Brazil and to work with Itaú to help design and to help manage some of the global multi-asset portfolios. In Brazil, as you know, there are two parallel waves of financialization and internationalization, financial deepening at the level of households here. There's simply more people involved with financial markets. And between retail investors and institutional investors alike, there's been a dramatic increase in interest in global investing. And so that's really what I'm here to do, think about global investing and how to put that specifically into a Brazilian context. And so you ask a very, very relevant and difficult question about investment horizon in Brazil. One of the things that I noticed immediately when I arrived here, and part of my indoctrination into the Brazilian investment landscape, is that there's really no adequate concept of long-term, right? So coming from the U.S. perspective, I would say my strategic asset allocation, the one you would hold absent any views on what's going on right now in financial markets, that horizon is something that encapsulates, that circumscribes an entire business cycle, right? So 10, 15 years would probably be about the time horizon that's right. What is it in Brazil? Is it next quarter, next month, next week? There's really no broad agreement except for the fact that it's a much shorter time frame. And so Brazilians are much more sensitive and tend to rethink what their asset allocation is very frequently. And one observation, one prediction for the future would be that that's going to change over time. That's going to change because a lot of what's happened over the last 30 years that caused Brazilian investment horizons to be so short are not necessarily going to repeat themselves over the next 10 to 15 years. So what's happened over the past 30 years? There have been big periods of hyperinflation. There's been a global commodity supercycle. There's been several rounds of policy, both fiscal and monetary overhaul. And so as we look forward, we're seeing a little bit more stability in terms of those aspects of the Brazilian financial landscape. And I think over time, what you're going to see is that investment horizon increasing gradually, but steadily over time. And so the tectonic plates are simply shifting around a little bit more slowly, and her investment horizons are gonna increase. And I think, given that we're talking about index strategies here, that long-term strategic asset allocation is a very natural domain for index strategies. Those long-term asset allocations, by definition, are thinking about what are the index level, asset class level exposures that you want to be holding for the long term. And so the conversation over the last few years has really migrated into what are the appropriate weights within those indices and across those indices. But it's really an index level conversation that we're having here in constructing long-term portfolios.
Yeah, it's been a challenge here to expand this investment horizon, but I really think that we've been making some progress. Instead of just looking for the next week, we're nowadays looking for the next month. And let's hope that one day we can focus more on the 18 up to 12, 4 months. And then we will be really thinking about how to build an efficient portfolio. So, Tim, having said that, take advantage of your experience here. Simple question. How one can build an investment portfolio using index strategies? I know it's a very broad question. Nowadays, we do have a lot of talking about the 64 portfolio. So how you advise our investors to take advantage of BT strategies in the portfolio building?
Yeah, I'm going to answer in a way that I just wanted to pick up on the notion of time horizon. And it's something that really distinguishes index portfolio construction from traditional stock picking portfolio construction. If you are picking stocks, individual stocks, you have to be very sensitive to what are the conditions for that stock? What's going to happen on their earnings? What happens today? What happens tomorrow? Because it is not true that you want to hold any stock for the very, very, very long term. Eventually, in the future, someone will come and replace all the heroes of today, the same way that they replaced those heroes that were originally in the Dow index 125 years ago. However, the overall market will welcome new sectors, new companies, and will follow the evolution of the economy. And really the way that indices allow, or that these kind of beta exposures allow investors to extend their planning, extend their time horizon, and focus on an asset allocation as opposed to a stock allocation, does something really powerful. Because the data shows that it's very hard to pick the best stocks. It's really hard. It's a very hard job and it takes a lot of time. But the data also shows that over the long term, the equity markets offer a return that is very suitable for many investors. And equity markets diversified with fixed income can offer a balanced, diversified long-term return. And for many investors, the actual challenge working towards a very short-term time horizon is not a welcome challenge, it's a necessary challenge. Coming back to your simple question, how can you use indices to build portfolios? The simple answer is you can use indices to build long-term portfolios that allow you to take away your attention from what's happening day to day and think about things that you may actually be able to achieve predictably, which is about a long-term pattern of risk and return and diversification.
Indeed. And as you just mentioned, in the end, it's quite important to find a balance between the asset class allocation, how one can balance equities, alternatives, fixed income, and also to take in consideration the geography of the investments. All this will count to be in a diversified portfolio. So one thing that we can try to bring here is the thematic investment scene that it brings a lot of transparency to our investors. And another thing that it's catching a lot of attention nowadays is about inflation. And I'll do a spoiler here. I know, Ben, that you just finished a paper regarding portfolio construction under inflationary regimes. Could you please talk a little bit about this work? What are some strategies that can help to protect the portfolio from a growing inflation scenario across the globe that we're just experiencing?
Inflation is a terrific example, a way of combining different index strategies into an efficient portfolio, insofar as it's really geared towards what are the asset class correlations with a big macro phenomenon like inflation. Inflation is one of the biggest. And so it really flexes all the muscles of portfolio construction, thinking about what are the shocks, what are the correlations, and how do you assemble them in a reasonable way. And those are basically the three steps. First, you want to define what is the economic or market phenomenon, what is the theme that you want your portfolio to be geared towards. So in the case of inflation, it's deceptively simple, right? It's not just a matter of how fast are prices rising. It's really a question of a variety of shocks that are affecting Brazil's inflationary landscape. As I mentioned, Brazil has a long history dealing with inflation and never really achieved the type of great moderation types of outcomes that developed markets did, where volatility, both market and economic, declined in a very long-term pattern starting in the 1980s and 90s. And so really what Brazil is facing vis-a-vis inflation is a series of idiosyncratic shocks specific to Brazil that cause inflation to rise, but of course also the global shocks which cause inflation to rise everywhere. And so the second step, once you know what the shocks are, is to think about what is the gearing, what is the correlation of your different asset classes to those shocks. And so it turns out that you have very different gearings depending on what the shocks are. So if you're in your kind of day-to-day inflation world where it's really not a huge shock, either idiosyncratic or global, those correlations are the highest for things like inflation-linked bonds here in Brazil. You're getting paid to take inflation risk via an inflation risk premium. But also the global inflation hedges that are kind of related to just the level of the tide elsewhere. So thinking about REITs, or just thinking about U.S. fixed income as being adequate coverage for those types of things. So that's the day-to-day. But what happens when you have a big shock, and what happens when the thing that you want to hedge for actually ends up materializing? In the case of the global inflation shock, our research has shown very high correlations with things like commodities, both international and domestic. So internationally, that would be something like the Bloomberg Commodities Index. Domestically here, it would be the materials portion of the Bovespa Index. And then, of course, in the case where the rest of the world is more normal vis-a-vis inflation, and it's Brazil inflation specifically that's rising, it's things like cash, CDI. You can't get away from that. But also the materials portion of the Bovespa, and also international exposure. Just simple exposure to the dollar. exposure to treasuries, exposure to even foreign equities. All of those are diversifying in the case where Brazil is having an inflationary shock and no one else is. And then the final aspect is portfolio construction. So what are the right weights to be putting on all these different asset classes? And I guess the real takeaway from our work is that there's no magic bullet, right, to deal with an inflationary shock. You have a series of shocks. You have uncertainty around what the best approach is at any given time. And therefore, the optimal combination is really a blend of strategies for those day-to-day shocks, the global shocks, and the idiosyncratic ones. And so really, we're looking at the gamut of inflation hedging assets as all being part of the solution here.
Yeah, that's a real example that will help our investors and better understand the steps in the process to in the building of a portfolio. And just to mention, wondering about inflation strategies, we do have our fixed income ETFs linked to the IPCA. Basically, we will be protected for the inflation in direct way. In the equity space, as you just mentioned, we do have our ETF of our basic material sectors. And also on the offshore space, as you comment on this, we do have a fund tracking the Bloomberg Commodity Index, a strategy who provides access to more than 20 commodities. So just to wrap up some of the concepts that we just mentioned here. So it's quite important to define our investment objectives, identify the scenarios that we're going to be running into, and also to pick the strategies that will build your portfolio that are aligned with our investment objectives that's supposed to have a better performance on the scenario that you're going to run into. So looking ahead, team, what do you think that will be the next steps for index strategies?
Yeah, great question. And I'd like to just kind of start with just a little comment, if I may, on this notion of, you asked the question about inflation, and you mentioned the notion of thematics. But I will come back, I promise, to your original question. But just, if I may, just to dig down a little bit, think about one theme. So biotechnology. Obviously, a lot of really interesting innovation going on in modern medicine. And there are also a lot of companies that are out there researching new techniques, new opportunities. And the way that biotechnology essentially works is it's very expensive research and design. And it's almost like playing a lottery. If you get it right, the opportunity is enormous, but a lot of the time you'll get it wrong. And let's suppose you're presented with the opportunity of 100 different companies who are focused on biotechnology. One of them might be successful, but even the scientists working at that company don't know whether or not they're going to be successful. And the challenge for an investor in identifying the one or two that is going to be the right ones is almost ridiculous. So what should you do when presented with a problem like this? Well, one option is to say, well, you know what? I'm going to hold all of them, and I'm going to guarantee participation in that one or two that become the absolute heroes, and I will participate. Now, I think this is a very simple idea, but it's actually connected in a very subtle way to challenges like inflation. And inflation is just one risk that is very present in the markets right now, but is also reflective of the past couple of years have seen extraordinary speed of change in politics, in markets, in social life. We are going through a period of history where change is happening dramatically fast. And in those changes, there are winners and there are losers. And sometimes the winners are given extraordinary rewards. Yes, inflation has its own particular way of approaching it, but in some sense, there's a similarity. You're presented with a very large number of options, and some of those options are going to be the right ones, but it is almost impossible to tell in advance which one is going to be the best one. And coming back to it, the notion of portfolio construction, diversification, using indices is about ensuring participation in the parts, the emerging trends as they come and as they succeed. Now, to come back to your original question, what's next? What do I think is the frontier for indexing? I'd say that there are many, but to go back to something that we discussed right at the beginning, and my sense, such as it is, of the Brazilian market, the frontier is time horizon. It's about evolving the way that we talk, think, and do our investing to focus on things that are actually achievable versus things which are very, very difficult and only achievable some of the time. Outperforming today is almost an impossible task to do consistently. If you do it most of the time, you're lucky. Building a portfolio that can succeed for you over a long-term horizon and deal with changes in the economy, changes in the macroeconomics, changes in politics, that is actually something that you can do. And I think the obligation on people like myself and yourself who work in this industry is about helping investors on that journey so that they can achieve the objectives that will work for them in the long term.
That's quite simple, but at the same time, it's quite difficult to to put in action. And I really like your thought about to make sure that my portfolio will participate in such a trend. You know, it makes us more comfortable that we don't need to be successful in any kind of investment, but just as a whole, as the portfolio, you know, it really brings the sense of a construction. That's very what we've been talking with our clients nowadays. So Ben, any thoughts here?
I mean, I really like the idea of the time horizon as really the frontier of where this is going over the next few years. You really have all the tools at your disposal, right? So you have what you need in terms of beta exposure to build a long-term portfolio. You have the liquidity in these index products to make tactical bets around that strategic asset allocation. And then, as you were discussing, you have thematic portfolios, which are interesting in part because they're a blend of frequencies, right? The themes themselves tend to evolve they're very slow moving. But they're by definition a tactical bet. You want to pick the segment of the market that you think is going to outperform because of its gearing to a certain idea, a narrative, theme, whatever you might call it. And so I think that's exactly it. Is what is the right blend of those frequencies, and what is the right blend of investments to get you where you need to go. There's one open question which I think has been on my mind. I'm not sure there's an answer. Maybe Tim has it, but this optimal blend of alpha and beta in a portfolio has been an open question for years now, and it's obvious, at least to me or anyone, if you believe that alpha exists, okay, why don't we start from first principles? If you believe alpha exists, you believe there's a role for both of these in your portfolio. So it's not a 0 and 100 or 100 and 0. But what is the right answer? Obviously, that'll depend a lot on an individual's or an institution's aims and objectives and constraints. So it'll be idiosyncratic by nature. But I think that question needs to get solved. And so I wonder what that optimal amount is.
Tim, well, quite simple question for you again.
You will be shocked to discover that working for an index provider, my opinion is that actually the index approach should be absolutely at the core of the portfolio. For some of the reasons that we've discussed, but for other reasons as well. This separation between beta and alpha also comes with a really important qualifier. Everybody who's investing can get beta. You can guarantee participation in the market. By definition, alpha is this outperformance. Alpha is I'm winning. And by definition, I can only win my alpha if somebody else provides it to me. If you look at the total marketplace, the total net alpha is 0. And for my own personal investing, I am happy to have a 0 allocation to alpha, in part because I know that actually I'm not the smartest person in the world, and that's okay. I will take the beta. And in the long term, the data suggests that is going to help me achieve my objectives and help me sleep easily at night. So is it zero? Not necessarily. But for me, yeah, you'll be shocked to discover that as an index provider, I'm not seeking alpha, but I am definitely seeking beta.
Yeah, it's a very interesting discussion, and we do know there is room for both strategies. The magic here is try to find the balance, align with your investment objectives. So, as you both mentioned, there is no 100% portfolio, right? You just need to find the right balance. So, guys, thank you for your time. Thank you for your thoughts. Very insightful discussion here. I really appreciate your time. Então é isso, pessoal. Espero que vocês tenham gostado desse mais novo episódio discutindo construção de portfólios através de estratégias beta. Acho que a gente trouxe aqui diversos ângulos pertinentes dessa discussão. E me deram um puxão de orelha agora, porque eu não falei o nome e os tickers das estratégias. Então, nos ETFs de renda fixa, a gente tem o IB5M11, o IMA-B11 e o B5P211, são os ETFs de renda fixa atrelados à inflação. Na parte de renda variável, o nosso ETF ligado ao setor de materiais básicos é o MAT-B11. E na parte de commodities, a gente tem o Itaú Index Commodities, também lançado no ano passado, que te traz a oportunidade de acesso a mais de 20 commodities. Obrigado pela sua escuta. Até a próxima, pessoal.